Okay, good afternoon or good morning to the West Coast friends, or to anybody in Australia, just good day. Welcome to the Charter School Facility Center webinar on borrowing in the time of COVID, a discussion of short-term versus long-term borrowing. The first thing I want to mention is this webinar will be recorded. At the end of it, we'll give you a web address to get a recording of this. We'll also send it out to all the registrants. Because I know that's always important. Today's discussion will have a conversation that we'll get started here in a minute. At the end, about 30 minutes after that, we'll have a question and answer session. In the Zoom box, there's a Q&A box. You can ask your questions there and we'll direct those to the panelists. There's also a chat function if you have some administrative questions or just want to introduce yourself or welcome yourself to the rest of their participants. So today I'd like to just turn it over to our moderator, Adrian Ruiz from Raza Development Fund, and he can introduce the panelists and we can have a conversation about borrowing decisions here during a pandemic. Adrian?
Awesome. Thanks, Mark. Good afternoon, everyone. Or good morning is for me here on the West Coast. As Mark mentioned, my name is Adrian Reese, and I'm the Deputy Chief Investment Officer and Head of Education Finance for Raza Development Fund, which is a national CDFI with a 20-year history of lending to charter schools across the country. This afternoon, we've got a great panel of folks that will be discussing the nuances and considerations to be taken when deciding to borrow short or long term for a facility, and as well as the ways we're thinking about folks that are thinking about providing greater flexibility to schools, and really especially in light of all this uncertainty that is occurring right now within the sector. So today, joining me on the panel today are going to be Stephanie Valle, the Executive Director at Tech Valley Charter Schools in Albany, New York. Molly Mello, Senior Director of K-12 Education at the Reinvestment Fund, and Anand Kesavan, Chief Executive for Equitable Facilities Fund. So I think we're going to have the opportunity to hear some pretty diverse and valuable perspectives on really both the lender side as well as from a school leader who just recently went through this process. And I think it's really a timely discussion as schools and lenders continue to evaluate facility needs for not only now, but for the future and how things might need to adapt. I know we here at RDF as well as other short and long-term lenders are certainly looking at schools and their projects through a new lens, a new COVID lens. Whether that's going to be sensitizing for pupil revenues and enrollment projections, or taking a deeper dive and looking at construction risk and the ability to actually complete the project on time. All while simultaneously really reevaluating our current portfolios and identifying those that are at most risk during the downturn. Whether that's offering deferrals where appropriate, some lenders even providing covenant waiver letters, due to some of the anticipated reductions in PPR. And even outside of the facility sphere, some lenders are really looking at providing capital to schools for technology infrastructure that's going to be needed as education kind of shifts to more of an online platform, and looking at different methodologies for instruction delivery, and even lenders that are providing bridge financing for startup grants. And and even before the onset of COVID, there's in the CDFI world, there's been different ways of how folks have been looking to diversify their capital sources to be both a short-term bridge lender and also a long-term lender as well. And but I think the reality is that this takes on really a new look as we deal with the consequences of COVID, and we look at the current environment and to the future. I think it's a good time now that we bring in our panelists to kind of get their insights. And so Stephanie, I'd like to begin with you and direct this first question your way. As someone who just recently went through this process, I'd like to hear from you and share with the audience what kind of questions did you ask yourself and the lenders during your search for facility financing?
Sure. Thanks, Adrian. And so just, quick background context. We just, actually a week ago now, closed on a $30 million refinancing. And so the context for that was a consolidation of our debt as a result of a merger with another independent charter school. And so we were looking at a refinancing package that can consolidate 5 different lenders, 6 different loans into one consolidated financing. And so, we really started looking at a wide variety of options, CDFIs, capital markets, traditional banking partners. And our question did quickly become, what was the best solution? Was it something that was short-term, or was it locking in longer-term financing, when we had the opportunity to do so as part of this? And so questions that, we were asking the lenders and the underwriters that we interviewed were really getting at the team that we were going to be working with. I think, in my personal experience in closing out and working with 5 different lenders who are mostly CDFIs, I really saw the value of having a lender that was a true partner and was able to work with the school. And so we really wanted to know who we were going to be working with and what that partnership was going to be looking like. We asked lenders and underwriters, what their creative ideas were, and that was where, some of our best ideas and sort of helped guide where we ended up was hearing, lenders' ideas. We really wanted to know how COVID and the pandemic and the resulting fiscal and academic uncertainty was going to impact the decision to lend or to underwrite, and how that uncertainty was going to play out moving forward. What did that mean for our financial covenants? What did that mean for academic benchmarks we were pledging we were going to meet? And I think we really wanted to see what flexibility for the future a lender could provide us, both in sort of the growth plans we already had, but in how we were also going to be adapting our program in this remote learning environment, and really having a lot of uncertainty about what the next couple of years is going to look like. So I think, and then, finally, question that we were asking ourselves was really just what was the risk that we wanted to take? Was this the time to enter the capital markets? What was, indicators of what the market was going to look like over the next 6 or 24 months that could indicate whether this was the time to lock in long-term financing, or if a bridge or a shorter-term loan was the best option. So those were sort of some of the highlights.
Awesome. Yeah. So it sounds like flexibility was something that was really, really important to you during this process, and again, considering the uncertainty. And so Molly, I'd like to bring you into the conversation as well, and really like to get your insights on perhaps what type of flexibility you all are offering during this time, and perhaps share some insight about how, just in general, how lenders have really had to change their approach to K-12 lending during the pandemic.
Sure. Yeah. So Reinvestment Fund continues to be really active during the pandemic. I think things have even upticked for us in a lot of different ways, both monitoring our current borrowers and having frequent conversations with them as they're trying to weather this new time, and also working with new schools to us and those that we were talking with even before the pandemic started. I think that most CDFIs would echo that they're open for business, perhaps with a range of degree of caution between lenders. But as a mission-driven lender, our mission is really to provide capital to fill gaps in the traditional financing market, whether that's higher loan to values, leasehold loans, working with earlier stage schools. And we recognize that at this moment, we're really needed now more than ever for many schools, since there are more gaps in the market than there were pre-pandemic. Historically, CDFIs like Reinvestment Fund have provided shorter term loans. Now there's really a range of tools we have for schools that range from very long to short, but our kind of core loan product has been about a 5-year mini perm loan for new and early stage schools, usually their first loan that helps them secure a building, perform leasehold improvements. And ideally, by the end of that 5-year mini perm loan term, the school has built up enough equity, grown its enrollment, has gone through renewal, and has a strong track record to support a favorable long-term financing takeout. So we're kind of used to being in the role of providing a bridge to get the school to a stronger position to access more favorable long-term financing. And a key part of our underwriting process for that short-term loan is really ensuring that the school will be in a strong position at maturity for a refinance. And this exercise is also just as important now more than ever. And we're actually seeing a number of schools we're working with that are looking for a shorter term than 5 years to allow the ability to refinance within the next 2 years in the event that there's more certainty at that point around per pupil funding, and in turn more favorable long-term options through traditional banks or the bond market. And we've been actually structuring a number of rate resets in some recent deals as well. So providing a 5 or 7 year mini perm loan, but with the ability to prepay after 2 or 3 years to allow the school that option and flexibility. I think having the conversation with the lender, really some of our most critical structuring conversations are around loan term, because that term really depends on where a school is in its development and thinking through the next 5 to 10 years of growth plans and when it will be in a really good position for long-term debt.
That's great. And as you start to think about schools and sort of on the short-term end of the spectrum, and as you kind of given the amount of uncertainty that's around, has there been any tightening of perhaps of credit standards, or especially for folks who have more of the limited operational history? Has there been any changes to your underwriting considerations at all that you've had to adapt?
We have been spending a lot of time thinking about sensitizing per pupil rates and actually looking at the 2008 recession in the various geographies where we work and how school funding was impacted and how long it took schools to kind of get back to a more stable funding environment. So any underwriting really being able to dig into the per pupil assumptions and be really conservative, especially in the next 5 years. So I know the moment we're in now is a lot different from the recession in 2008 for a whole host of reasons, but that has been a good proxy for us in seeing how schools and funding has rebounded. So in Philly, for example, where one of Reinvestment Fund's offices are, state revenue for schools decreased through 2012, so for the next 4 years, and there weren't consistent increases in rates until about 2016. So we are assuming decreases in per pupil funding kind of with a more nuanced approach depending on the geography without a rebound until at least 2025 to be conservative. And that also fits into thinking about the loan term and when a school may be well poised for a takeout depending on where it is in its trajectory. We also work with a number of new and early stage schools, so which we've always kind of dug into questions around enrollment demand and how you're recruiting staff and families, and that has also just gone to another level in these times where schools have had to adapt to have that virtual marketing. So really trying to understand their role in the community. And it's been actually really inspiring, especially for the current borrowers we've had as we've checked in along the way to see the services that they're providing to families even beyond instruction, whether that's helping with food access, whether it's helping just having communities have like a town hall place for a voice in these really uncertain times. Going kind of beyond our typical underwriting and looking at the school's role in the community is something that we've been spending a lot of time on too.
Awesome. Yeah, I'd like to bring Anand into the conversation because you got a pretty relatively new long-term product that's there that is specifically unique and catered to a specific type of organization that where the bar for quality is really high, and you expect to have some operational history, and would really love to get your insights as to how you at EFF have really adapted, or in the changes that you all have had to make, during the current crisis, especially looking at it from a long-term perspective.
Absolutely. Thanks for all you do, Stephanie, for sharing your experiences here at KIP in Albany, and Molly, and you guys for staying open and lending in this difficult atmosphere. And I want to echo what Molly said, that this is the time when mission-oriented lenders should be stepping up to the plate and being open, creating financial access for communities that historically have been shut out of financial access in tough times. This is why we exist. Markets, we should step up. We made a strategic decision with the Facilities Fund in Q2 after the virus started to spread, that we're going to make this our busiest quarter ever and double down on quality schools. So quarter two was our busiest quarter ever, staying open, really increasing our underwriting capacity to, as Molly said, to find out what's, to separate the schools who are doing really well in this crisis, not necessarily struggling, and not penalizing them because of the virus. And that's been a core focus for us in this quarter.
I think we might be having a little bit of trouble hearing you, Anna. Your sound is kind of cutting in and out a little bit. But with that, Molly, I'd like to turn it back to you, just really, really fast, and just kind of talk about sort of why you think perhaps maybe a short-term loan structure right now might be the best fit, kind of in light of all the uncertainty that's here. If you can just kind of share your brief insights.
Sure. I mean, I think it all really depends. I think I would answer a question of, what's the right term for a school, even before this pandemic, I always hate saying it depends, but it really does depend on the circumstances of the individual school and where you are in your development. I think a school that's undergoing a construction project, we've had a couple of schools that were looking initially to the bond market, but instead are pivoting to look for 24-month interest-only construction loan to save on interest costs, but also allow some time for more certainty in a long-term takeout when the building is built, and at the end of that 2 years, when that construction risk is no longer something that a long-term lender would have to think about. And also seeing, a shorter term option for those schools that are really in growth mode, which is, typically what we would have seen pre-pandemic too, of, enabling your organization to be in the strongest places possible when you're trying to lock in a long-term loan.
Yeah, I think that's, again, we hate using that term of it depends, but there's a lot of factors that really go into formulating for a school to go into that, ultimately decide what's the best decision for them. And every situation and organization is unique. And I'd like to bring you back, just to give us your perspective from, not from a competitor standpoint, as offering a long-term product, but really, your role, your organization's role in being provider of a much needed product that is going to be the great connector between these schools that are able to tap into the short-term financing, but are really, and the important role that you as a long-term takeout organization plays in this space.
Thank you, Adrian, and I apologize if my audio is not good. Please do stop me if it's not. We believe that public schools, all public charter schools, should belong in long-term financing, just like you would go get a mortgage and finance it for 30 years, because our schools are permanent and their financing should be too. Now, that's not always possible. It's not an option that's always available, but we do think that the long-term option should be the primary option on the table if and when schools qualify, especially in this environment around where we don't know where the market's going to be. We don't know how risk factors are going to be in the next year or two. So if it's available to lock in, we do think that should be a primary option for all public schools, including public charter schools, which it hasn't been in the past. Our goal, our mission is to make that accessible to all high quality public charter schools earlier. So as Molly said, schools may need a bridge loan, but we believe they should get into permanent financing as soon as they qualify. Now that might get to the question, well, what does it take to qualify? So my first suggestion is to put all the options on the table, including long-term debt. And if you don't qualify, then you move to a short-term option. And to qualify, we really look at three buckets of attributes. One, school quality, academics, proven academic performance, proven enrollment demand. And you know, Stephanie can talk to this all day about why KIPP Albany is a great school. Two, financials. Can you afford your building on your current enrollment and on your current financial pro forma? Is your building less than 15% of your recurrent per pupil revenue? And third, ops and leadership governance. How long have your leaders been around? How experienced your board members? What's your teacher retention look like? Usually, if you can qualify on those three categories, school quality, financial metrics, and leadership and governance, you can qualify for a long-term loan.
Great. And again, those are all really important factors. And Stephanie, I'd like to bring you in back into the conversation again. Is in considering that, you know, obviously you guys are very high performing and had your litany of choice and options there for of lenders to be able to choose from. You know, kind of walk us through if absent the situation with the merger, you know, and you had more time to really focus and make a decision. You know, I know that you were kind of hammered with sort of making the July 1 deadline. But you know, what are other factors that you might have considered that might have driven your decision outside of just outside of the merger?
Yeah, I think, you know, the merger provided for us sort of the combination of, you know, high academics and a more secure financial picture. And so this was really, as we were looking at it the first time, we were able to be in the choice of, you know, qualifying for some of the long-term financing like Anna mentioned, and having the metrics across the board to be able to do that. And so I think, you know, that was obviously a new thing for us to consider, being at that stage of our growth where long-term financing was an option. And so I think, you know, as you mentioned, for us in this unique circumstance, the July 1 close date ended up being the most important factor of just needing to, you know, make sure that we closed out our existing debt by that point. But as we were thinking about, you know, the long-term considerations, that really became appealing, is to be able to lock in, you know, a low rate for 30-year financing. It, you know, and that's certainly the direction we're moving to over the next, you know, 6 to 12 months, is that having that certainty to be able to plan, you know, is incredibly valuable as we look at, you know, crafting our 5-year plan. One of the important considerations for that too, which lenders like EFF really offer schools, is the ability to continue to grow even with that existing, you know, long-term debt. And that was a key consideration for us. Right now, where, you know, 4 schools, a K to 8, having a high school is top on our mind. And so we really wanted to make sure that we would be able to take on, you know, as we were considering this debt, our eye was on like our next deal and what future debt needs were going to be. And so I think that was really a top consideration for us, is how this debt would both, you know, put our current profile into a better position, but even more importantly, how would, you know, this debt allow us to grow in the future. And so as we looked at covenants and, you know, what additional indebtedness requirements were, those were some of our most important considerations, is finding a lender that understood the reason why we want to have a high school. And so I think, you know, that's why, you know, so many of the mission-based lenders we've found such strong partnerships with, because they're really just true partners, and they want to see us grow and serve more kids just as much as we want to.
Yeah, and so it sounds to me like you've got some pretty good thoughts about future growth as an organization, and you know, a lot of the folks, both Molly and Anand, have really mentioned it about, you know, really school quality is going to be the top of mind, and really is not only for schools but for mission-driven lenders as well. I'd really like to get Molly, your insight, given that obviously we don't have academic results for this past year, and there's even talk about possibly not having academic results, for this upcoming year. And considering that academic quality really does play a huge role in underwriting, and absent these results, how are you all viewing school quality and determining whether a school really meets your credit worthiness standards?
Yeah, it's a really good question. I mean, academic results, even before we get a full loan application from a school that's interested in financing, we ask upfront for their academic results and audits. So it's kind of like our very basic starting place of giving a red light or green light based on those assessments. And the fact that 2020 will be a year without data for all schools, and going forward is really uncertain what it looks like or what the new baseline will be. Schools that we've been underwriting recently, we've spent a lot of time talking with the authorizer, which is standard for our underwriting process, but even more so now, really digging into what the authorizer is expecting of schools, how they're reviewing their continuity of education plans, how they're thinking about renewals. I know in at least one of the geographies we serve, all renewals next year are going to be pushed 1 year. And that authorizer spoke, really in depth around other metrics that they will be looking at, like staff and student satisfaction, climate data, other interim assessments that take place, and not having as much weight on the academic piece during 2020, looking at prior years of data. So for an existing school with more of a track record, having those conversations with the authorizer and looking at history is really where we'd start. For an earlier stage school, it's a trickier question. And I think it really gets to the strength of the management team and understanding the program that the school has and how they're ensuring that that program is equitable for all students, whether they're in person or not. But it's definitely something that we're spending a lot of time on, both with our current borrowers as we're monitoring their operations during this time, as well as schools that are coming our way. And I think having that open dialogue with authorizers to hear what their expectations are is super important, so that we're all on the same page.
Stephanie, before I go into get your perspective from the school side, Anand, is there anything that you'd like to add that you are looking at as an organization?
No, similar to what Molly said, enrollment, attendance. We'll look at internal assessments, MAP scores if they exist. We'll look at for schools that have a history, operating history, and the history of their academics. We'll look at teacher retention, student mobility. That's college matriculation, graduation rates to the extent they're available. It's tough. It's really difficult without state test scores to differentiate schools. But those are the assessments we'd use in the meantime.
Right, and Stephanie, conversely, I'd like to, for you on the school side, how are you all evaluating school quality in the absence of state results, and considering that may impact some of your future growth decisions, your ability to source additional capital for that growth? What advice would you give schools, as they approach lenders with limited assessment data?
Yeah, it's obviously challenging, as Molly and Anand both said. State tests scores, while imperfect as a measure of schools, at least provide a baseline, point of comparison. And I think, we found with schools in New York, fully shut down by mid-March, we did not even have a lot of, valid assessment data and other assessments we normally use, like interim assessments or MAP data, because with kids learning from home, there's just really no valid way to standardize the testing environment and student conditions at home to even get valid data on some of our existing internal tests. And so, what we thinking about in the lens of refinancing and financing in general, what we really appreciated was working with partners on, what is our remote learning plan? How strong is our plan? Could we answer the questions of how are we delivering technology and internet access to all of our students? What are our participation rates? What are, rates of proficiency? How are we handling and reaching out to the percent of students that weren't opting into remote learning? I think, that sort of school quality metrics on some of those items become even more important when you have an absence of then, some sort of norm reference like data, and state test results. And so I think that's really where we were digging into is what was the quality of remote learning we were delivering. Knowing that I think, I speak for probably all school leaders, remote learning just generally isn't very good. And so what were we doing to adapt to that and try to overcome that?
Yeah, it's certainly going to be incumbent on perhaps on schools as they go and seek financing to really educate their partners and their lenders about perhaps looking at school quality in a different lens. Especially as we consider as schools are on sort of an online learning platform that learning loss has the potential to be a big factor, and so the assessment results even in future years perhaps may not be up to the same standard that folks are traditionally accustomed to. So I think that certainly brings on an added level of importance in educating lenders and partners to really have a different understanding as we kind of go through and navigate through the future. And before we jump into the Q&A, I'd like just to wrap up with one final question just to all the panelists, and really just give your general and broad insight as to what do you think proactive charter school leaders can do as they consider financing their projects during these times. And I'd like to just throw that out to all three of you.
Happy to jump in from my perspective first. I think, assembling a good team of advisors was really critical for us. We started the financing process in late January, early February, thought we were in, pretty stable, good market conditions, and things quickly changed. And so the ability to lean on, some financial advisors and strategic consultants and our attorneys through this really helped us be able to adapt to the changing market, while at the same time recognizing a lot of our school leadership focus was on the really urgent mission of pivoting to remote learning. And so from my perspective, I found having a good sort of expanded internal KIPP Albany team was really helpful in how we were able to navigate this.
Yeah, I'm happy to jump in too. I mean, I think really starting with the biggest question, is this the right time for this project? Because lenders will be scrutinizing that pretty closely. Is this the right time for this capital project or refinance, depending on what the case may be, and doing some scenario testing yourself so that you can show a range of what you can afford and how you think about your budget and your staffing and your expenses at this time, really honing in on what are the key expenses that you really need and what are the levers that you may have if per pupil rates decrease. How are you thinking about some COVID related expenses in the nearer term, and kind of your cash needs there too. I think the other piece to keep in mind, and I know it's a question mark right now for a lot of places, what the fall is going to look like. But a really key part of our underwriting is a site visit and visiting schools and observing classes and getting a sense of culture firsthand, and not having that in-person connection is definitely a challenge for any new school to us that we hadn't visited in the past or don't have a relationship with already. And so I think there are ways to, mitigate that, but really thinking for schools to think about how to best convey what it is that they're providing to students and staff and families in that more virtual way, involving stakeholders or authorizers in those conversations, to try to give the lender who may be new to your program a real glimpse into what a day in the life of a student there is like is really important.
Anand, would you like to take us home before we jump into the Q&A? Nope. I think we might have lost him. Well, thank you. Appreciate you both sharing your insights. Mark, I'd like to pass it over to you to kick us off on the Q&A.
Thanks a lot, Adrian. So we've had a prepackaged question that's come in the past, and this has been for schools who are trying to figure out exactly where to start. So Stephanie had mentioned building an important a team, expanding her internal capacity was really important. But I think at that point, then a lot of people are like, well, now what do I do? Who do I call? Where do I, is there yellow pages for lenders, et cetera? And so some colleagues took a page from the SBA, the Small Business Administration, to, they have a program for small businesses that are looking for lenders. It's called Lender Match. And I hate to say it, but it's a dating matching program. So you type in some information about you, and it'll find partners for you that are a good lender for, in that case, small businesses. So anyway, they've created the Lending Project now. So it's thelendingproject.com. And as you can see, this is the front page of that site. For borrowers, you type in some information about yourself, and that'll try and match you with potential lenders. And for lenders, and I think there's a few on the webinar as well, you also can fill in your profiles, which will make your organization available to borrowers. This doesn't create a loan. It doesn't even start the lending process. It just helps borrowers find lenders that are a good match for them, both short-term and long-term. So we'll see if this new matching app can help ease the process for schools who may not be excited about having to make 40 phone calls to 40 different CDFIs or investment banks or commercial banks seeking transactions. So that was one of the questions that's always been asked in advance. And then for everybody else, if those still participating in the webinar, use the Q&A box in Zoom and ask some questions. We'll take a few of those. We've already got some that came in both in the Q&A box and the chat room. And then we will provide some more information for people to learn more about this. Adrian, if you want to take that first question in the box.
Yeah, absolutely. So we've got Molly. We got one for you in the chat. It says, based on your assessment of the impacts to per pupil funding from the 2008 financial crisis, what impact should schools expect to see? For example, different rates, covenants, other terms, if they're seeking lending in the current environment.
Yeah. It's a good question. Yeah, our covenants have not really changed significantly pre-post pandemic. I mean, debt service coverage is standard 1.2 times coverage typically for most schools. And I think what we're looking at really closely too is liquidity and cash. So having 30 days cash on hand really as a minimum. But digging into how the school is dealing with some upfront expenses, whether it's related to technology or cleaning facilities, just everything that's going on with getting everything virtual. For terms, our rates right now range between 5 and 6% usually for a mini permanent loan. We do have a floor on the way that our fixed rates are calculated at the time of closing, which is a little specific to how our funding comes in to Reinvestment Fund, but it's something that we typically wouldn't have, but in this rate environment and the economics for us need to have. So something to ask lenders about. I think the prepayment penalty question is always something to ask about upfront when you're thinking about terms, especially if you're looking at a short-term loan. To make sure that you understand what you're signing up for and that you and your lender are on the same page around what your plans are, both short and long term. The other piece too is collateral and loan to value requirements. CDFIs tend to have a higher loan to value threshold than traditional banks. And in this age where real estate values may be having some pretty negative impacts. That has had more scrutiny really in our internal credit committee. And so we've been, trying to offer as favorable loan to values as possible, but it's another conversation to have with your lender up front, and, to have an appraisal done early on in the process to see what the value is, whether there's any gaps there.
So it sounds like, even though there's some things that may be changing here, that you're kind of combating that with the flexibility, that schools are really, really looking to, that they're going to need, during this time. And so that is awesome to hear. We've got a couple more questions in the Q&A box. And Stephanie, I'd like to direct this one to you. It really goes into about leasing options. And question is about, what about long-term lease options? What's the benefit of ownership over a locked-in long-term lease if the school is a nonprofit?
Yeah, I mean, I can speak mostly. We made the decision to purchase all of our buildings. And so for us, and that was largely a result of just what was available in Albany and sort of the upstate New York market. And so for us, the purchasing and continuing to build and own our buildings has really given us the most flexibility that we needed. In addition to, in New York State as a nonprofit, we're exempt from certain like mortgage recording taxes and things like that, which does make it more, affordable to purchase versus lease. And we've also then, seen value in owning our buildings during this time period of uncertainty, because as there's improvements that need to be made on the buildings to make buildings safer for return to school, and even just like access issues to buildings, we've been in control of those. So I don't, personally have experience in having the flip side of that, of a longer term lease. But, from our perspective, the value of owning our buildings has definitely made a difference for us.
Yeah, it's also a matter of just kind of building up your balance sheet, especially as you as an organization are looking to grow and look at additional sources of capital in the future. A strong and stable balance sheet is something that most lenders are going to really look to, just to see that there's some stability there, from an asset holding perspective as well. So we've got another question here. Molly, I'd like to throw this one back at you about, how are you, and I think you touched on this just a little bit, but how are you thinking about interest rate volatility in terms of the decisions to, whether, just in general, how are you thinking about interest rate volatility?
So we are pretty confined by how our funding comes into Reinvestment Fund. Most of our loans for a mini permanent loan are fixed at closing based on an underlying treasury plus a spread. And as I mentioned, we have a floor in there, usually around somewhere in the 5s at this point, to protect against some of the volatility that's been going on. One of the loan products that we have that's not short-term, guarantee program, that's a longer-term loan option that many CDFIs have allocation for, does not have a floor. It actually has really favorable rates these days. The last I checked, I think last week, it was like 4.3% for a 25-year fully amortizing loan. And that has been a really great option for a couple of schools that we're working with that we're looking to refinance ballooning new markets or other debt that's coming due. And so I think it really depends on the lender and their sources of capital and how their economics are working. And recommend having conversations with them upfront on that.
Yeah. Mark, would you like to chime in just to talk about interest rate volatility and how that factors into the decision making for schools as they decide whether to go in a short-term or a long-term credit facility?
Yep. Anand's connection was in and out, so he was chatting some of the answer to me, and I'll weigh in here. So I know at this point you can get a quote for an interest rate from investment banks and short-term lenders and long-term lenders. One of the things that EFF is trying to do is once they give a quote of a rate, that's the cap, that's the rate you'll get. If for some reason interest rates are going to drop again, then there's a chance that your rate can be reduced after that. It's called a cap and reduce strategy. Given the volatility, certainly, just the last 60 or 90 days here. So while sometimes it may be hard to believe that rates could even go lower than they are today, I think we're at, if over the last 15 years, there's only, I think maybe a few days where the rate has actually been lower than this. But we never know. Like, right, we've seen other countries have really attractive, for if you're a borrower, low rates. So there's flexibility for that, and I think there's just ways that the lenders are trying to be creative here during high volatility times.
Great. We've got a couple more questions here in the Q&A, and Molly, I'll kind of direct this one back your way again. And in light of what's in store for schools and networks this fall, what would you look for in a remote learning plan to ensure attendance and enrollment projections are met?
Yeah, that's a good question. I mean, I think one of the things that we've been hearing, and we were just actually talking with Stephanie about this before going online, is different scenarios that schools are thinking through and how they will be hopefully able to pivot depending on what's happening. So if you're starting in person and have to pivot to more virtual, really hearing about how they're thinking about that. And really depending on where a school is in its growth, if they are needing to do a lot of recruiting of staff in this remote environment, how is that working? How is student enrollment happening? And how solid are those figures? Interestingly, most of the schools in our portfolio through the end of last year really didn't have any impact on enrollment in terms of students leaving or attrition. If anything, it was a bit higher than in previous years. And I think that given some staff layoffs that are happening, unfortunately, at the district, charter schools may be in kind of a stronger position in terms of recruiting talent. So there's kind of things to weigh there, but really hearing how the school is able to pivot and what are the various options they may have, how they're engaging with families, and what that virtual instruction really looks like. It seems like, and again, I'm not an educator in the schools, but it seems like last year was such a rush of folks trying to figure out what to do. It was such an urgent situation, and now that there has been some summer weeks for planning and kind of hopefully thoughtfulness around the upcoming fall, understand there's still a whole lot of uncertainty, but hearing too what lessons schools have learned from just the last couple of months in terms of student engagement and family engagement and keeping that sense of community even in kind of an uncertain hybrid / virtual time.
Yeah, I think you bring up a great point, and Stephanie, I'd like to have you weigh in on this, and especially communities that are highly distressed are really leaning on schools as really these community centers, and really look to them at providing critical resources, and not only just apart from the academic side. And so I'd like to get some insight to you as how you all have addressed that and what that has done as far as from a student retention strategy, for enrollment, because obviously that's going to play a critical role and a thing that lenders look to. So I'd like for you to weigh in on that.
Yeah, I think, that's something we've really been focusing a lot of our time on is how are we separating from district schools in Albany in this time. And so, by, the inherent flexibility that comes with being a charter school, how are we able to change, staff expectations and job obligations to really meet the needs of our families now. And so, that has looked a lot of different ways. Certainly being a food distribution point for our families and making sure families had easy access to food, to changing the socio and emotional support we were providing to students. This also then, we had the compounding factor of the murder of George Floyd. And then, in Albany, there was a number of protests and some local impact from that. And so we had families and students who were already in, difficult and unstable situations. And then, Black Lives Matter and being able to talk to our students about that became even more important. And how did we do that in a way where we weren't together and we couldn't grieve as a community, we couldn't heal as a community. And so for us, I think, we've seen value in, students, the number of students that are staying with KIPP, the, strong enrollment numbers that we're getting, and how we're reaching out to, students who are starting with us in the fall with, things like KIPP swag and other things to make them feel welcome remotely. We've really seen, our attention to providing different types of support, have value in students staying with us. Another important aspect of that has been our commitment to be fully one-to-one on technology, and how we, reprioritize, what we were spending money on to be able to do that, because that was a promise that at least locally district schools weren't able to make. And so I think similarly, families felt some certainty, and no matter what school looks like in the fall, their students would be best positioned for success, either enrolling in or staying in a charter school.
That's great. I think those are valuable lessons for and strategies for folks who are on the call to really continue to engage their families in a meaningful way moving forward. We've got another question in the Q of A. Mark, perhaps you might want to weigh in on this one as well. But the question is positive flow of funds into the high yield tax exempt funds fueled the remarkable low rates available for charters in the 60-month period prior to March. After March, the flow of funds into high yield funds has been anemic at best and still largely negative for unrated transactions. And is there any insight that you might have as for a forecast of whether and when investment fund demand for charter paper gets back to pre-January 20 levels? And that's a pretty tricky question.
Let me pull out the crystal ball. Yeah. We're seeing inflows now into high yield, so that's good, but most of it is rated. So the question from the audience member is spot on, especially for somebody who's unrated or higher risk transaction. It's going to be hard pressed to imagine that we're going to come out of this anytime soon, right? Like, you hear people talking about years when they talk about time for the economy to stabilize and vaccines and whatever else is going to be involved in bringing us out of this recession. So I think if a school was unrated and really worried about the widening spreads here, two steps would be: one, improve your rating. So go short, try and figure out how to bridge this and strengthen the credit rating of the school. Or B, if you're hell bent on trying to find long-term options, look for credit enhancements, and these can either be state-based ones. So we got a few states that have some cash-funded credit enhancements. There are some other states that have more obligations. Right? This is a chance for schools to get into the policy game and try and bring more states into a credit enhancement feature. Or find a fund that's credit enhanced. So similar to EFF, who has philanthropy that's backing that fund and helping them blend down rates and take risks for some of these higher rated or higher credit risk schools. Luckily we're seeing the spread shrink a little bit for the higher rated, the investment grade schools. So that's helpful, but getting to pre-March 20 is, I think it's going to be a while.
I certainly think that we're still kind of a long ways out, towards kind of seeing those pre-pandemic levels. But I think you brought up a good point, and that's where the role of the reinvestment funds of the world, the RASA development funds of the world that can really serve as a bridge during this time of uncertainty and provide some needed short-term capital as the markets begin to stabilize. So I think that's an excellent point to bring up. Molly, you wanted to weigh in?
I was just going to say the schools that we had been, talking to about a short-term construction loan were those that were initially thinking about an unrated transaction. You have an independent operator looking at unrated financing pre-pandemic. And so, yeah, I kind of echo what Mark said there. Just until things get more certain on the funding side of things and operation side of things, I think it'll be tricky on the unrated side.
And I would just add, we were looking at, a low investment grade rating. And so even at like low investment grade, we were seeing a market that we didn't want to enter either. And so I think it expands even, beyond the unrated transactions.
I think we've got time for this last question here, but it really talks about, the CSP program really incentivizing applications for opportunity zones, and how do you all kind of see opportunity zones so far as a catalyst for charter school investments or reinvestments? And I will say from my standpoint, I've not yet to see a charter school facility project that's been funded with opportunity zone, an opportunity zone fund. But not sure if any of the other panelists have had any other experience.
We have learned of one. There's a school in New York that was part of a mixed use development, so it wasn't a pure play charter school investment. Whether the school benefited from lower rates because of the investments, probably questionable. But it may be true to say that the project wouldn't have happened without the opportunity zone. So there's, I think, maybe a benefit to a project like that. Given that it's been a couple of years since the regs came out or first came out, we just don't see a lot of movement in opportunity zones in charter schools to date. There are some people I think who are still more optimistic than myself on this, but the evidence is just not. It hasn't materialized yet. So I don't know if anybody else has a thought on that. Otherwise, we are approaching on the 2-hour mark. I know we have, we're going to lose a couple panelists here right at the hour. So I did want to say thank you very much to Adrian for moderating the panel today, and to Molly and Stephanie and Anand for joining us and weighing in and providing their insights. If you want to know more about, first of all, if you want to get a copy of this, it'll be posted at the facilitycenter.publiccharters.org. We'll again send a link to all the participants for that. If you want to follow this topic and others, join the LinkedIn group, Public Charter School Facilities. And if you have any questions, feel free to reach out to the Facility Center. There's my address at any time you ever want to, or more questions to follow up on this topic. The panelists' email address are on this page. So thank you again from the Facility Center, for the panelists, the moderator, and stay tuned. We'll have another webinar next month. That'll be our 5th during the pandemic here on reopening schools. And I hope we'll learn a lot from Brooklyn Lab, who's got some exciting work that they've been doing about how to get ready for back to school whenever that may happen. So thank you again for everybody joining us, and stay safe, take care of yourself, and in the words of Stephen Drubner from Freakonomics, if you can, take care of someone else too. Bye-bye.